$113. Look at that number. Let it sink into your consciousness. $113 per ounce of silver. 6 months ago, the so-called experts told you silver would never see $50 again. 3 months ago, they said the rally to 70 was a bubble that would pop any day. 1 month ago, when silver crossed 90, they screamed that it was irrational, that it was speculation gone mad, that it would crash back to earth and punish the foolish silver bugs who had ignored their wisdom. They were wrong about 50, they were wrong about 70, they were wrong about 90, and they are wrong about 113, because what is happening right now is not a bubble. It is not speculation, it is not retail mania, or social media hype, or any of the other dismissive explanations that the mainstream financial media uses to avoid the truth. What is happening right now is the great melt-up. It is the moment when decades of monetary abuse finally manifest in the price of real assets. It is the moment when the fiat currency system begins its terminal decline. It is the moment when those who hold paper watch their wealth evaporate, while those who hold metal watch their wealth multiply. Ladies and gentlemen, this is Silverstorm Daily, and tonight we are going to explore the most important question of our financial era. Is the fiat system failing? The answer is yes. It is failing right before our eyes. Silver at $113 is the proof. And by the time I finish this video, you will understand exactly why this is just the beginning. Let me start by defining what a melt-up actually is, because this term is being thrown around without proper understanding. A melt-up is distinct from a normal bull market. In a normal bull market, prices rise gradually as fundamentals improve. Earnings increase, demand grows, supply tightens. The price responds proportionally to the changing fundamentals. The advance is measured, rational, predictable. A melt-up is something entirely different. A melt-up occurs when prices rise parabolically not because the fundamentals have improved proportionally, but because confidence in the alternative has collapsed. People are not buying silver at $113 because they calculated that silver is worth exactly $113 based on discounted cash flows and supply-demand models. They are buying silver at $113 because they have lost faith in the paper assets they previously held. They are fleeing, they are escaping. They are abandoning a burning building and running toward anything that offers safety. The melt-up is a refugee crisis in financial form. The refugees are fleeing the fiat currency system, and silver is one of the lifeboats they are scrambling to board. This distinction matters because it explains why traditional valuation metrics are useless in a melt-up. The analysts who say silver is overvalued at $113 are applying normal market logic to an abnormal situation. They are measuring silver against the dollar as if the dollar were a stable unit of account. But the dollar is not stable. The dollar is collapsing. When you measure silver in dollars, you are measuring a constant against a variable. The constant is silver. 1 ounce of silver is 1 ounce of silver. It contains the same number of atoms today as it did 100 years ago. The variable is the dollar. $1 today purchases a fraction of what it purchased 100 years ago. The purchasing power of the dollar has been destroyed by deliberate policy. And that destruction is accelerating. Silver is not going up. The dollar is going down. Silver at $113 is not expensive silver. It is cheap dollars. The melt-up will continue as long as the dollar continues to lose value, and the dollar will continue to lose value as long as the Federal Reserve continues to print. Let me show you the numbers that prove the fiat system is failing. The United States federal debt stands at $37 trillion as of this morning. That is an increase of $2 trillion in the last 6 months alone. The government is spending $2 trillion more than it collects in taxes every year. This deficit is being financed by borrowing, and the borrowing is being facilitated by the Federal Reserve creating new money out of thin air. The mechanics are somewhat obscured by technical jargon, but the essence is simple. The Treasury issues bonds to cover the deficit. The Federal Reserve purchases those bonds with money that did not previously exist. This new money enters the financial system and dilutes the purchasing power of all existing dollars. It is counterfeiting with legal sanction. It is theft with a government seal. The interest payments on the federal debt now exceed $1 trillion per year. That is more than the defense budget. That is more than Medicare. That is more than any other single line item in the federal budget. And the interest payments are growing exponentially because the debt is growing exponentially and interest rates are not at zero anymore. The government is borrowing money to pay the interest on the money it already borrowed. This is the definition of a Ponzi scheme. It is mathematically unsustainable. There is no scenario in which the debt is ever repaid in dollars that have the same purchasing power as the dollars that were borrowed. The only way out is default or debasement. Default is politically unacceptable. Debasement is already happening. The melt-up in silver is the market's recognition of this reality. But the federal government is only part of the story. The corporate debt market is similarly bloated. American corporations have issued over $13 trillion in bonds, much of it at artificially low interest rates that prevailed before the Federal Reserve was forced to tighten. As these bonds mature and must be refinanced at higher rates, corporate earnings will be squeezed. Bankruptcies will increase. Layoffs will follow. The economic contraction that results will reduce tax revenues and increase government spending on unemployment and welfare, making the federal deficit even worse. The debt spiral is self-reinforcing. Each problem creates new problems. Each solution creates new costs. The system is consuming itself. The household sector is not immune. Total household debt in America now exceeds $18 trillion. Credit card debt alone is over $1.3 trillion. Auto loans are $1.6 trillion. Student loans are $1.8 trillion. Mortgages are over $12 trillion. The American consumer is leveraged to the hilt. They are one paycheck away from disaster. When the economy weakens, when layoffs increase, when asset prices fall, the defaults will cascade through the system. The banks that hold these loans will face losses. The derivatives that are built on these loans will implode. The contagion will spread. This is the backdrop against which silver is trading at $113. This is the context that the mainstream analysts ignore when they call silver a bubble. Silver is not a bubble. Silver is a barometer. It is measuring the pressure in the system, and the pressure is at explosive levels. Every dollar that silver rises is a vote of no confidence in the Federal Reserve. Every ounce that moves from paper to physical is a withdrawal from the fiat banking system. The melt-up is the manifestation of a collective awakening. Millions of people around the world are simultaneously realizing that the paper promises they have been accumulating are worthless. They are converting those promises into real assets as fast as they can. Silver is one of those real assets, and the demand is overwhelming the supply. Let me now examine the specific mechanics of how the fiat system failure is driving the silver melt-up. The first mechanic is currency debasement. When the Federal Reserve creates new money, the purchasing power of existing money is diluted. This is not controversial. It is the explicit policy of central banks worldwide. They target 2% inflation, which means they explicitly target a 2% annual decline in your purchasing power. But the actual inflation is far higher than 2%. The government's inflation statistics are manipulated to understate the true rate. They use hedonic adjustments, substitution effects, and geometric weighting to make inflation appear lower than it is. The real inflation rate, measured by the methodology that was used in 1980, is over 10%. At 10% annual inflation, your purchasing power is cut in half every 7 years. The dollar you save today will buy 50 cents worth of goods in 2032. This is not theoretical. This is happening, and people are responding by converting their dollars into assets that cannot be debased. Silver is one of those assets. The second mechanic is negative real interest rates. The nominal interest rate on a savings account might be 4 or 5%. But if inflation is running at 10% or higher, the real interest rate is negative. You are losing purchasing power by holding cash in a bank. The rational response to negative real interest rates is to spend or invest the money rather than save it. This increases the velocity of money and drives prices higher. It creates a feedback loop where inflation begets more inflation. People buy assets today because they know those assets will cost more tomorrow. This buying pressure drives prices higher, which validates the expectation of higher prices, which drives more buying. The melt-up is this feedback loop in action. Silver at $113 today will be silver at $150 in 6 months if the inflation continues. Buyers know this. They are acting accordingly. The third mechanic is the flight from financial assets. For decades, the investment playbook was simple: buy stocks and bonds. Hold them for the long term. Trust the system. The stocks go up because the economy grows and corporate earnings increase. The bonds pay interest and return principal at maturity. The 60-40 portfolio was gospel, but this playbook is breaking down. Stocks are not going up because the economy is growing. Stocks are going up because the Federal Reserve is printing money. The multiple expansion that has driven equity returns is a monetary phenomenon, not an economic one. When the money printing stops, or when inflation forces the Fed to tighten, the stocks will fall. Bonds are not safe either. Bond prices move inversely to interest rates. If rates rise, which they must to combat inflation, bond prices fall. A bondholder can suffer losses just like a stockholder. The 60/40 portfolio is no longer a safe harbor. It is a trap. Sophisticated investors are recognizing this. They are reducing their exposure to financial assets and increasing their exposure to real assets. Silver is a real asset. The flow of capital out of stocks and bonds and into silver is one of the drivers of the melt-up. The fourth mechanic is the collapse of trust. The fiat system depends on trust. Trust that the central bank will manage the currency responsibly. Trust that the government will honor its obligations. Trust that the banks will safeguard deposits. Trust that the rules will be applied fairly. This trust is eroding. The Federal Reserve promised that the inflation of 2021 and 2022 was transitory. It was not. They were either lying or incompetent. Either way, their credibility is damaged. The government is running deficits that are clearly unsustainable. The banks have been bailed out repeatedly, rewarding reckless behavior and punishing prudence. The rules are applied differently to the powerful than to the ordinary. The system is visibly corrupt. When trust collapses, people seek alternatives. They seek assets that do not depend on the honesty of central bankers or the solvency of governments or the integrity of banks. Silver has no counterparty risk. It does not depend on anyone's promise. It is real wealth that exists independent of the system. The collapse of trust is driving people towards silver and away from fiat. The fifth mechanic is the geopolitical fragmentation. For 50 years, the dollar has been the world's reserve currency. International trade was conducted in dollars. Central banks held their reserves in dollars. This created artificial demand for dollars that propped up its value. But the reserve currency status is eroding. The BRICS nations are building alternative payment systems. China is settling trade in yuan. Russia is demanding payment in rubles or gold. Saudi Arabia is considering pricing oil in currencies other than dollars. Each transaction that occurs outside the dollar system is a reduction in demand for dollars. As demand falls, the dollar's value falls. As the dollar falls, silver rises. The geopolitical fragmentation is accelerating the melt-up. Now let me explain why the melt-up in silver is different from and more powerful than the melt-up in other assets. Silver has characteristics that make it uniquely suited to benefit from fiat system failure. First, silver is scarce. There are approximately 2 billion ounces of above-ground silver in the world. That is roughly a quarter of an ounce per person on the planet. Compare that to the trillions of dollars, euros, and yen that exist in digital form. Silver cannot be printed. It cannot be created by central bank decree. It can only be mined from the earth at a rate of approximately 800 million ounces per year. The scarcity is absolute. It is physical. It cannot be manipulated away. Second, silver is both an industrial metal and a monetary metal. The industrial demand provides a floor under the price. Solar panels need silver. Electronics need silver. Electric vehicles need silver. Medical devices need silver. This demand is growing as the world electrifies and decarbonizes. The monetary demand provides the upside. When people flee fiat currencies, they buy silver as a store of value. The combination of industrial floor and monetary upside creates an asymmetric risk-reward profile. The downside is limited by industrial consumption. The upside is unlimited in a melt-up scenario. Third, silver is accessible. An ounce of gold costs over $3,000. That is prohibitive for many small investors. An ounce of silver costs $113. It is affordable, it is divisible, it can be accumulated gradually over time. This accessibility means that retail investors can participate in the silver market in a way they cannot participate in the gold market. The democratization of sound money investing is happening through silver. The retail inflows are a significant driver of the melt-up. Fourth, silver is undervalued relative to gold. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged around 15 to 20. Today, with gold at 3,200 and silver at 113, the ratio is approximately 28. This is still elevated by historical standards. If the ratio compresses to 15, which is the historical norm, silver would be worth $213 per ounce at current gold prices. If gold continues rising, which it will in a melt-up, silver would be worth even more. The ratio compression trade provides an additional tailwind to the silver melt-up. Fifth, silver was suppressed for decades. The bullion banks kept silver artificially cheap through paper manipulation. They created an abundance of paper silver that masked the scarcity of physical silver. This suppression is ending. The paper market is disconnecting from the physical market. The manipulation is failing. Years of suppressed prices are being unwound in months. The melt-up is partly a catch-up for the decades when silver was not allowed to trade freely. Let me address the question that is on everyone's mind. How high can silver go? The honest answer is that no one knows. The melt-up is driven by psychology as much as fundamentals. It depends on how fast trust in fiat collapses. It depends on how much money the Fed prints. It depends on whether there are black swan events that accelerate the crisis. But I can give you frameworks for thinking about possible targets. Framework 1 is the inflation adjustment. Silver peaked at $50 in 1980. Adjusted for official inflation, that is approximately $190 today. We are currently at $113. We have not even reached the inflation-adjusted previous high. By this measure, silver is still cheap. It could rise another $77 just to match the 1980 peak in real terms. Framework 2 is the gold ratio. If gold reaches $5,000, which is widely expected in a melt-up scenario, and the gold-silver ratio compresses to 15, silver would be priced at $333 per ounce. If gold reaches $10,000, silver would be $666. These numbers seem outlandish from today's perspective, but they are mathematically derived from historical relationships and plausible gold prices. Framework 3 is the monetary base. If silver were to back just 5% of the U.S. monetary base, the price would be over $1,000 per ounce. If it were to back 10%, the price would be over $2,000. A monetary reset that includes silver as a reserve asset would require a dramatic repricing to match the outstanding currency with the available metal. These scenarios are not certain, but they are possible. Framework 4 is the replacement cost. The marginal cost of producing silver from primary mines is approximately $20 to $25 per ounce. But the easy deposits are depleted. New deposits are deeper, more remote, more expensive to extract. The replacement cost for new silver supply is increasing. If the price must rise high enough to incentivize new production, it could reach $200, $300 or higher to make marginal deposits economic. I present these frameworks not as predictions, but as possibilities. The melt-up is inherently unpredictable because it depends on human psychology in a crisis. What I can say with confidence is that $113 is not the top. It is not even close to the top. The fundamentals support much higher prices. The melt-up psychology supports much higher prices. The failure of the fiat system guarantees much higher prices. The only uncertainty is timing. Now let me talk about the psychology of the melt-up, because understanding the psychology is essential for participating successfully. The melt-up creates unique emotional challenges. The price rises so fast that it feels wrong to buy. Every purchase feels like buying the top. The fear of a pullback is constant. The temptation to take profits is overwhelming. These emotions are natural. They are also destructive. They will cause you to sell too early and miss the largest gains. The melt-up psychology is characterized by 3 phases. Phase 1 is denial. The early stage of the melt-up is marked by widespread disbelief. The mainstream analysts say it cannot continue. The financial media calls it a bubble. Your friends and family think you are crazy for holding. Silver went from 30 to 70 in this phase. The deniers missed the move because they could not believe it was real. Phase 2 is acceptance. The middle stage of the melt-up is marked by grudging recognition that something has changed. The analysts revise their targets upward. The media coverage becomes less dismissive. New buyers enter the market. Silver went from 70 to 113 in this phase. The acceptors are buying now, but they are nervous. They are constantly worried about a correction. Phase 3 is euphoria. The late stage of the melt-up is marked by universal enthusiasm. Everyone is bullish. Everyone is buying. The price rises vertically. The gains become parabolic. This is when the largest moves occur. This is also when the risk is highest. We have not entered this phase yet. Silver at 113 is still phase 2. The euphoria is coming. When it arrives, the price will move from 100 to 200 faster than it moved from 50 to 100. The mistake most investors make is selling in phase 2. They capture the initial gains and then exit, thinking they are being prudent. They watch from the sidelines as phase 3 takes the price to levels they never imagined. They either miss the top entirely or they FOMO back in at the worst possible moment. The correct strategy is to hold through all 3 phases and only sell when the fundamental reasons for the melt-up have been resolved. The fiat system failure is not resolved. The money printing is continuing, the debt is growing, the trust is collapsing. Until these conditions change, the melt-up will continue. Hold your silver. Let me now address what the fiat system failure means beyond silver prices. Because this is not just about making money. This is about understanding a historic transformation that will reshape the global economy and your place in it. The fiat system that is failing has been in place since 1971. when President Nixon closed the gold window and ended the convertibility of dollars to gold. For 53 years, the world has operated on a pure fiat standard. Currencies are backed by nothing except government promises. The experiment has run its course. The promises have been broken. The system is ending. What replaces it is unclear. It might be a return to some form of gold or silver backing, at least partially. It might be a central bank digital currency that gives governments even more control over money. It might be a decentralized system based on cryptocurrencies. It might be a fragmented world where different regions use different monetary systems. The transition will be chaotic. There will be winners and losers. Those who understand what is happening and position accordingly will be among the winners. Those who cling to the old system and trust the institutions will be among the losers. Silver is a hedge against the chaos of transition. It is real wealth that will retain purchasing power regardless of which monetary system emerges. If a new gold standard is adopted, silver will be valued alongside gold. If central bank digital currencies dominate, silver will be an escape from government surveillance and control. If the world fragments into competing systems, silver will be universally recognized and tradable across boundaries. Silver is the constant in an equation where every other variable is changing. Holding silver is not just an investment, it is a survival strategy. The fiat system failure will have consequences that extend far beyond monetary policy. It will reshape politics as governments lose the ability to fund themselves through inflation. It will reshape society as the middle class discovers that their savings have been stolen. It will reshape international relations as the dollar's reserve status ends and America's ability to project power diminishes. These are not exaggerations. These are logical consequences of a monetary system that is mathematically unsustainable. The consequences are already beginning to manifest. The political polarization, the social unrest, the geopolitical tensions. These are symptoms of a system in crisis. The melt-up in silver is another symptom. They are all connected. Let me give you specific guidance on what to do with this information. First, if you own silver, hold it. Do not sell because the price has risen. The price has risen for good reasons. Those reasons are intensifying, not diminishing. The melt-up is not over. It is accelerating. Selling now would mean converting real wealth into failing currency. It would mean surrendering your position in the lifeboat to swim back to the sinking ship. Second, if you do not own silver, buy it. Yes, the price is higher than it was. Yes, it feels late. But the melt-up psychology guarantees that it will always feel late until it is actually too late. The fundamentals support much higher prices. The supply is constrained. The demand is exploding. The fiat system is failing. These conditions favor silver. Pay the current price, pay the premium, get the metal. The price you pay today will seem trivially low compared to where silver is going. Third, prioritize physical overpaper. The paper-silver market is fragile. The ETFs are being drained. The COMEX is facing delivery challenges. The divergence between paper and physical prices is widening. In a true crisis, the paper claims may not be honored. Only physical silver in your possession or in allocated storage provides true protection. The paper is convenient but risky. The physical is cumbersome but safe. Fourth, think about silver as insurance rather than speculation. You do not buy fire insurance hoping your house burns down. You buy it to protect against the possibility. Silver is insurance against fiat system failure. You do not need to predict the exact timing of the failure. You just need to be positioned before it happens. The cost of the insurance is the premium you pay over spot. The benefit is protection against a scenario that would otherwise devastate your wealth. Fifth, prepare for volatility. The melt-up will not be smooth. There will be corrections, crashes, and manipulations. There will be days when silver drops 10 or 20%. These drops are opportunities, not threats. They are chances to add to your position at lower prices. Do not let volatility shake you out. The long-term trend is clear. The short-term noise is irrelevant. Sixth, diversify within real assets. Silver is excellent, but it should not be your only holding. Gold provides stability. Mining stocks provide leverage. Land provides tangible utility. Diversification protects against the specific risks of any single asset while maintaining exposure to the broad trend of real asset appreciation. Let me conclude with a reflection on what this moment means historically. We are living through the end of an era. The fiat currency experiment that began in 1971 is ending. The debt supercycle that began after World War II is reaching its climax. The American century that defined global politics is transitioning to something new. These are not small changes. These are tectonic shifts that will be studied by historians for centuries. Within this larger transformation, the melt-up in silver is a small but significant event. It is the market recognizing what the politicians will not admit. It is price discovery overcoming manipulation. It is reality asserting itself against propaganda. Silver at $113 is a statement. It says that real assets matter. It says that scarcity matters. It says that paper promises are not as good as physical possession. The people who understand this statement, who hear its message and act accordingly, will navigate the transition successfully. They will preserve their wealth while others lose theirs. They will maintain their independence while others become dependent on failing institutions. They will be positioned to rebuild when the destruction is complete. I do not know exactly how the fiat system failure will unfold. I do not know the precise timeline or the specific events that will mark its stages, but I know that it is happening. The math is undeniable. The debt cannot be repaid. The currency is being debased. The trust is collapsing. The melt-up in silver is the proof. $113 is not the end. It is not even the beginning of the end. It is perhaps the end of the beginning. The great melt-up is underway. The fiat system is failing, and those who hold silver will be among the survivors. This has been Silver Storm Daily. Silver stands at $113 as the great melt-up accelerates. The fiat system is failing before our eyes. The evidence is overwhelming. The response is clear. Hold real assets, hold silver, trust the fundamentals, ignore the noise. The storm is here, but we are prepared. Like, subscribe, and share this video with everyone who needs to understand what is happening to our monetary system. The truth is our weapon. The metal is our shield. See you in the next report.